Good afternoon or good morning, traders and investors around the world. Welcome to the first day of February, February 1st. This is a Tuesday. January's done. What's next? We'll bring in Rob Friesen here in a minute or so to give us his statistical outlook for the month of February. We're doing okay, folks. It's a rock and rolling session here. Matched the pre-market high. You know how I love my pre-market highs. Matched it. Took out the pre-market low, but not by much. Took it out by 4 handles, and now the battle for 4,500 continues. Big old turnaround in crude. It's rallied almost $2 here off the low. Multiple lows at the 86.50 area. We're now in the green by 8 cents at 88.23. In order to post a high close in the move, keep an eye on 88.15. Gold in the green by 760 at 18.04 even. Silver doing better on a percentage basis. That's up 34 cents, 22.74. Bitcoin, what happened to the Bitcoin volatility? Up $40, 38.525. Ethereum futures, they're moving a little bit better north on a percentage basis. Up 2.64%, 27.56.50. Rob, what a January, huh? And now February.
Yeah. Pretty exciting January. I mean, always challenging when you come into a new year and you don't know what the investor slash hedge fund slash institutional sentiment is, and how that plays out. We did have some ebb and flow of fundamentals matter, but then hey, if things get cheap enough, we're willing to buy some of the riskier assets again. Yesterday you saw pretty strong move on the Qs and the Russell versus the SPY, some outflows on that. Yeah, it's you've heard the saying, as January goes, so goes the year, right?
Yeah, I do. I don't know. I think I want to make one prediction about this year.
Oh, you want to make a prediction? See, humans love to predict.
Well, wait till you hear what my prediction is.
All right, let's hear it.
This year is going to be unpredictable.
I love it. No, actually, that's pretty good, right?
That's the way I feel.
That's like, hey, that's like, what's the superpower at the end of the world? Is it China? Is it the US? Is it Russia? What's the last superpower?
I guess we're still up there until they knock us off our keister, huh?
The way things are going with the mistrust of governments around the world, it might be anarchy. I mean, anything's possible, right? So,
all right, talk to me about the end of the month, the implications you got for the end of the month,
from
and
end of the world to end of the month. Yeah. Okay.
Yes, I think that'd be a little bit easier to put into context.
All right. So January is down 5.3%, right?
Mm-hmm.
If we look at all the Januaries since 1950 that have been down, the average is about 3.6% down for the month. So what happened in the remaining 11 months? On average, it went up about 5.4%. So let me ask you something. If I gave you $10 and I said, give 50% of it back, how much would that be?
$5.
Okay. If I wanted to make you whole again, how much in percentage terms would I have to give you back?
100%.
So if on average the market is up 5.4%, everybody looks at that and goes, well, when Januaries are down, right? You know what I'm saying? So be careful of like headlines or interpretations without actually applying a little bit of critical thinking to it, because if January is down on average 3.6% and then the remaining months are 5.4%, that's not something to throw a party for, right?
No.
I mean,
no. It's a great point.
So, I mean, so there is some truth to, as January goes, so goes the year, but also it can be completely meaningless. It's not that relevant anyway. There is more relevant themes in place, one of them being the Fed cycle, interest rates expected to hike in March, and what are the odds on a quarter versus a half. But I was sharing on Saturday with a workshop that we did for the bright traders, Goldman's kind of looking at the historic side of things related to how does energy perform around the first rate hike of a cycle. So we're going into the very first one of a cycle. How does energy perform? How does financials perform? So while we're kind of thinking pro financials because of rising rates, they actually found that financials underperform. So when we look at our seasonality calendar in StockOdds, it says that month of March, XLF is really supposed to underperform historically compared to the SPY. So that could really help us align ourselves with this backdrop of financials actually don't do really well right before and right after. I think 3 months, they're looking at right before and then 3 months after the first hike. They don't actually perform that well, but energy, on the other hand, does. Now, you also put that in the backdrop of what just happened. We had, energy up 17.3% for the month, right? We had financials already slipping down and only up 1.7 for the month. So we're coming on the back of that. Obviously, you know that even with the rally Friday and yesterday, the tech stocks are still down for the month. So that's how it played out for January, and that some of that theme is continuing into today. So, a lot of people can get pretty excited about that Friday rally and then a rally yesterday right up into, I would say, former support, new resistance. Would you have said the same thing?
Let me see here.
Pull up your SPY and your
diamonds and your
I mean, it was what about our December lows? What about
that's a good call. That's good.
September, we got September highs, we got December lows. I mean, we even had another retest of that low area in December. So I'm thinking that this area is one to be contested.
Oh, big time.
Right? Like if people had actually bought early in January because of the prospects, and the first day out of the gate, we had a pretty good day on January. Was it
second?
It was third. I think it was the first trading day. Yep. So out of the gate, it was like, hey man, this is going to be great. So people that had bought, even in December, maybe they bought early January, they're going to be very relieved to get some of the money back or all of the money back or whatever, right? So some of these ETFs are widely traded, obviously. So it's like, well, hey, we're getting back. I think I'm going to say sold because this is looking pretty weird type of year. Like you said, very unpredictable.
So just another thing, just to add to the significance of this area, not only I do see the basis the S&P and the SPY that 4,500 was support, but what you've done in essence is if you've taken back half of this move, half of the break from 48.05 and a quarter down to 42.12, 17.
Yeah, there's also that retracement level.
That's
right?
big.
Absolutely.
If the market, if we can catch it, if we can hold in here for a day or two and close around here, then I would look out. Look out on the upside. Well, and I don't say that very often.
No, I agree with you, but I think there's a context behind that, and that is this argument between, are we going into a recession or not? Goldman said, hey, if you want to buy 10% dips if there's no recession prospect. But if there is a recession, that's a whole different thing. Then you're probably going to have this as a bounce that we end up doing the head and shoulders, knees and toes, and we'll be looking for the knees and toes later on this year, right? Okay.
Isn't it amazing? We just before we even get the first official interest rate hike, we're already talking about a recession.
Well, I know, but see, but that's the debate. Like,
That right,
we
right,
don't
right.
know. I don't know, right?
I
I'm
don't
not
know
an
nothing.
analyst, right? But here's the thing. Let me share my screen for a second.
Okay.
Screen two. So regardless of what you think, how the market should behave, or whether, okay, this is what January did, here's what we need to do for February based on that. I love to look at spread relationships, as I've told you, right? I think there's so much in the world of pairs and all that. So I was pointing out to some of my break traders this morning that I took this trade here. I'm flat now, but this was the Qs versus the SPY pre-market. We know how well the Qs did against the SPY, Friday's reversal, and then again yesterday, built up it right into the close. But look what happened pre-market. It was a pretty excessive premium. If you stack both days on top of each other, or even the last 3 days, and you say, what's the performance of the Qs? What's the performance of the SPYs? Is there any chance for mean reversion? And if there was, where would it go to? So that blue line is my expectation of where it would first drop. And I shorted it at the open and caught that move. So that's short the Qs, long the SPY. That's a lot different than being completely exposed to the market, but it is a beta play, meaning that I expect the Qs to move more than the SPYs. So hey, if it drops, that's going to work to my favor. It's going to give me, a beta play to the downside, which is great. So yeah, that's the trade, but you have to look at it in context. Where did it come from? Right? So context is a number of things, as we've talked about many times on this show, right? We've said, here's what goes into context. Here's what goes into context. Well, one of them is the performance comparisons. And I first did a small testing trade pre-market on the relationship to say, how does it feel? How's it performing? And it just seemed that there were sellers just kind of lurking on the Qs. They were just, I don't know, they were in the shadows, but they were ready to come out, and
They were sneaky. They were sneaky.
You know what I mean? Like you, if you just test it with, it doesn't have to be a full position, just small size. I don't think, I don't think traders do enough testing trades.
Good point.
You know what I mean? Like, we used to have this thing where when you were trading pairs, and I remember one of our Russian traders used to yell at some of his comrades, and it was like, how many orders did you place and cancel versus your fills? And they're like, 1 for 1. You mean to tell me that you're always getting what you want and it's working? Well, it's not working that great. Well, that's because you're not placing enough orders and canceling and moving them around to find those sweet spots. You're not testing anything. You're not saying, hey, how does this, if I'm reading the tape right, or if I'm looking at the chart right, what's the substance behind it? You're just making a decision and you're going all in. And I think testing and greater amount of samples. So we had a rule, kind of like, you need to place and cancel at least 10 orders for a fill if you're trying to get great spread prices. Well, how many people want to work that hard? Now with automation, you can have a lot of canceling and replacing and different things going on, but on a manual basis, point and click, it's a lot of work, right? But those great spread prices are what give you your benefit, right? I didn't make money because I picked the direction on Q SPY correctly in that sense. That wasn't my intention. My intention was the Qs are trading at a premium to the SPY. That's stacked on a number of days. I'm suspect about the rally continuing aggressively as it did yesterday because of the level that we're at, former support, now resistance. there's some premium in here, there's some frothiness in here. Let me test it. Yeah, it feels right. Let's do it. So it's based on what the spread is doing, not the guarantee or even the prediction that I have of what it will do. Right? Like Joel, you got to let the market do your heavy lifting for you if you can get great spread price. Right? So the same would be true for coming in for your basket trades today. Is like, you know, what things are potentially going to give some back. You know, even Visa, MasterCard yesterday gave some back on top of the day before, right? Friday, they were up 10.9%, I think, on Visa and MasterCard.
Visa earnings, yeah.
Right? Okay, but they gave some back yesterday, or they didn't participate as much with the market. You know, you're going to have these tensions in profit taking and, you know, continuation. And so there is always that challenge of, are things going to continue, you know, or are they going to pull back? And so it's always going to be riskier in tackling the most volatile issues, the most, you know, hot stocks, widely followed, like these are the theme stocks or something like that. It's always going to be more challenging than kind of working in the middle groups with more of the boring symbols. But there's a lot of benefit to staying away from the things where you have to be perfectly right, and really going in the middle where you can keep taking slices and not have to be perfectly right. You know, so even in this trade here, there is sometimes a very directional element to this relationship, because you're talking about the NASDAQ 100 versus the S&P 500. So, you know, you've got a different quantity of symbols, and you have some overlap and some different types of symbols that, you know, are very much sought after, you know, when people are buying tech. So the risk on, risk off applies almost more to the Qs than it does to the SPY. So in that sense, you know, it's not a perfect relationship. So it's going to have some trends, and it's going to have some consolidation areas. And when it rolls over, when it gets displaced and it starts coming back, it often goes back to a previous consolidation level. And you can see that here. And if it dropped further, I wouldn't be surprised if it, you know, came to rest around one of these other consolidation areas. Make sense?
Sure does. Yep.
So even if you're basket trading or pair trading, whatever, don't forget some of your, you know, index symbols. You can, you know, add weight directionally. You can, if you lock in some profit on your stocks, you can replace it with an ETF, or you can sometimes just find some good ETF trades. And here's what I suggest. Don't be sitting in a consolidation area, like if it drops down to here and it's in this consolidation, don't be sitting there going, I know where it's going to go next, because you don't. You might think you do, but you don't. It's better to find the arguments that support that. What's the context for why the trade should be put on long or short? And are you okay with, if you're wrong, what's the potential opportunity if you're wrong? Sometimes when you're wrong, you can still come out okay if you trade around your core position and you have enough chop. If it's completely directional, like for example, if somebody was buying this on the way down, you know, there's no opportunity to make money from any bounce on that. But, you know, if it comes to rest, like it has more so now, you know, and chops around, yeah, you could probably make money both sides. But when you're taking a core position, you know, and you want to make money from the drift, you have to be more right. So you have to have a really good contextual reason why you're in it, because you have to live with it, right?
That's right. Live with the results.
All right.
All
So
right.
don't forget to check the seasonality calendar for February. There are some especially look at your ETFs. Some of them are really quite favored for February historically. Some are not so favored. It is a better month than January just because we had a January 2021 that was very distorted on a lot of symbols, short squeezes, meme stocks, all kinds of weird stuff going on. So it was a tougher month to navigate using seasonality. February is a bit better. March, you have to be a little bit careful of in some groups, obviously, because of March 2020. And that kind of went into April a little bit as well. All the other months are more statistically muted. Okay.
Okay. All right. Sounds good. We're going to wrap things up. We're down 11, but not out. Just trying to hold in here. We're right at mid-range in the session, bouncing around only a 40-point range. So maybe we will just consolidate up here before our next move. Thanks for joining us here, Pre-Market Prep with Stock Odds. Back with you tomorrow, same time, same place.